What is the greatest technique for selecting a dividend investment that pays out on a regular basis? Do you choose the one with the biggest dividend, or is there more to the formula? When investing in dividends for the future, there are some parameters to consider. So let's get started. Income-seeking investors frequently make the error of purchasing equities only for their high dividend yield. After all, the greater the dividend yield, the better. A greater yield simply means that you will have more consistent revenue in your pocket. However, according to mutual fund managers who value dividends and strive to outperform the market, this is not always the case. Specifically, surpassing the market over the last 3 years is notable, given that most mutual funds underperform the market for a variety of reasons. These fund managers, Matthew Page and Ann Mortimer, choose to invest in firms that outperform in the long run rather than the short term. Here are 9 characteristics that successful investors look for in firms to help them return the greatest money to their investors. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. First and foremost, choose dividend growers. Dividend companies outperform as a group, but those that continually increase their dividend payments outperform even more. You want to invest in stocks that are expected to enhance their dividends in the future. Keep in mind that the annual rate of inflation is roughly 3%. Therefore, a growing dividend should be more than that. In other words, to maintain the same purchasing power, your salary must increase by around 3% per year. Don't be concerned about the existing yield. Rather, consider what it will be in the coming years. Number 2, look for companies that have a good return on capital. Companies that have a lengthy history of wisely investing in their businesses are likely to do so in the future. This implies that cash flow is expected to be sustainable, implying that dividends will continue to be raised. An excellent track record of long-term investing is something to look for. According to studies, organizations with a strong investment track record over a 10-year period have a 95% chance of repeating their performance in a year and an 80% chance over a 4-year period. There are numerous methods for assessing the obligations of corporate investment, but Page and Mortimer choose a metric known as cash flow return on investment. They consider a fair cash flow return on investment to be at least 10% over a period of 10 years. This metric is applicable to all companies, not only dividend stocks. Third, choose a dividend yield that is moderate. Investing in companies with the greatest yields may appear to deliver the best returns in the short run. However, buying a firm with a moderate dividend yield implies that the company will find it simpler to raise its yield in the future. If a stock falls yet has a good return on capital, it may be a short-term problem that will be remedied in due course. Fourth, look for healthy balance sheets. When a company is in financial problems, it is more likely to be forced to reduce its dividend in order to pay its debt or, worse, to incur debt in order to fund dividend payments. Often, a firm may appear to be doing well, paying a high dividend, but the wise investor is always on the lookout for dependable information. Further investigation may reveal that the corporation is unable to support its dividend and is overspending on those payments. A healthy balance sheet, on the other hand, indicates that the company is in good financial shape, and it is unlikely that the dividend will need to be decreased. If you rely on that revenue to meet your bills, you don't want reduced payments. Number 5, buy low-cost stocks. Cheap stocks do not merely indicate investing in a company because its share price is low, but that it is a good bargain. Use valuation criteria such as price to earnings and free cash flow yield to determine whether the company is trading at a discount. Make sure to compare a company to others in its industry or its own history, rather than the general market. Different measures are accepted in various industries. In other words, the price-to-earnings ratio, P/E ratio, in the technology sector is often substantially greater than in the energy industry. It's critical to look at these figures before buying a stock because you think it'll be a smart investment. Price analysis is one of many elements that go into selecting a profitable investment. 6, make focused bets. Many successful investors employ this strategy. This means buying only a few exceptional stocks that you know inside and out, rather than spreading your risk among companies you don't know anything about only to diversify. It's better to stick to a small number of companies and keep a careful check on them. These fund managers retain roughly 35 stocks in their portfolios, each accounting for about 3% of the total. The more investments you possess, the more difficult it is to keep track of them all. 7th, go shopping around the world. There are so many investments available abroad that you don't have to limit yourself to solely U.S. corporations. There are numerous established dividend payers all throughout the world, and this overseas exposure diversifies your portfolio even further. To establish a good balance of stability, risk, yield, and so on, these managers like to maintain around half of their portfolios in the United States and spread the other half among worldwide enterprises. Individual investors should restrict their global exposure to roughly 20% of their total portfolio because international companies frequently carry higher risk. Number 8, invest for the long haul. Since launch in 2012, Page & Mortimer's funds have had a comparatively low 24% turnover rate and have retained one-third of their positions, including Microsoft, Procter & Gamble, Johnson & Johnson, Aflac, and Royal Dutch/Shell. When you choose an investment in which you have confidence for a variety of reasons, such as a stock's financial situation, potential growth, management, and other criteria, there is usually no need to sell unless there are significant setbacks or changes. Many investors, particularly those looking for income, acquire and hold with no intention of selling. Number 9, improve your math skills. Page and Mortimer never attended business school, but they both have advanced physics degrees from Oxford. They are not as well educated as many fund managers. They are less prone to follow the crowd and think for themselves. When looking for investments, it is critical to be knowledgeable in fundamental math. If arithmetic doesn't excite you, consider how happy you'll be when you've chosen a home run investment. Focus on the other aspects involved in dividend investing rather than just the income. When wagering on collecting dividends, don't skimp on research. Instead, take caution. After all, many consumers spend more time studying their next new car or trip than they do learning about what makes a good dividend stock that can offer passive income to pay such spending. Using these guidelines can assist you in selecting quality dividend stocks to enhance your income. However, avoid investing too much of your portfolio to individual stocks. They are more hazardous and volatile than index funds or ETFs. A fair rule of thumb is to restrict your exposure to individual equities to 20% or less of your portfolio, with the rest invested in funds. However, this is a question of personal preference. Just make sure your risk is appropriate for your needs and tolerance for danger. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?